The markets have been heating up for too long, both crypto but also the stock markets. Everybody's just looking for the greater fool. Nobody's looking for fundamental pricing. And when we actually look back at the fundamentals on a historical scale, then we see at what kind of precarious situation we actually are. Take Tesla, for example. This is Tesla stock, and it seems like in the last 5 years, it still did fine. It still performed 60%. So yes, there is some volatility, but overall things should be okay. However, have a look at Tesla relative to the Nasdaq 100. It did not outperform the Nasdaq 100 at all during the same time period. So everybody that took on more risk buying individual Tesla stock over just the tech index did not perform better. Risk adjusted, it's worse, right? When you take on more risk, you get the same performance. It's not necessarily a great idea to take on that risk. So Tesla didn't do better than the Nasdaq 100, but the same is true for tech stocks relative to all other stocks as well. Again, when we look at 2020 up until today, this is the Nasdaq 100 relative to the S&P 500, we barely see any outperformance. All we see is more volatility. We see our occasional crash of 20%, but taking on more risk by buying technology over just plain old regular stocks like Disney or Coca-Cola would have not given us more return. 5 years of more risk and not more return. We can even make a more extreme case. This is gold relative to the S&P 500. And this chart starts in 2015. So this is now 10 years of data. And we did not see the S&P 500 outperforming gold over the last 10 years. Now there is a bit of a caveat to that chart because the S&P 500 is a price index. It's not a performance index. So on top of just having the price performance, we also get dividends. But also on top of dividends with the stock market, you also get management fees. You also get taxes. So if you're trading regularly or if you own a fund that is not a low-cost ETF, but something that has 2 or 3% of fees per year, then you're not doing better because then the dividends pretty much balance out with the taxes and the fees. So again, taking on additional risk by buying stocks versus gold over the last 10 years did not pay off. We're going up the risk hierarchy, right, from regular stocks to tech stocks to an individual tech stock to Tesla, and still, even with that increased risk, we never got more performance. So something is going on here. This is not how it should be, right? In theory, if we buy something more risk on, like tech stocks over regular stocks, we should get more performance, especially over the time span of 5 years or 10 years. Now in US dollars, all of those assets went up during the time, as we have seen with the Tesla example. But that's because of this here, right? It's because of monetary expansion. The US dollar loses value over time. And because of that, everything measured in US dollars goes up. This is USM2 and it tends to go up by 5.8% every year. When looking at all of that data, when looking at these relative valuation charts, it appears to me that the market has not taken on as much risk as it can digest. We seem to be maximally risk on, and from here on, we might only deflate. Because have a look at the historical price to earnings ratio. So this is the Shiller PE. It tells us how expensive are the future earnings that we currently buy with the stock market. So it looks at the stock market market cap relative to its future earnings. It's a 7-year moving average. That's the Shiller PE because there is some fluctuation in earnings. But again, this is a very long-term view. This chart starts in 1871 and we tend to fluctuate in somewhat of a stable range. This here was the Great Depression in the 1930s. This was the oil crisis in the 1970s. This was the dot-com bubble burst, and this was the global financial crisis. We are now again at historical highs. We barely have been that high with stock market prices. Earnings are now super expensive. Now with the adoption of Bitcoin by traditional finance, so the Bitcoin ETFs, we have seen more and more correlation of Bitcoin performance and say the Nasdaq 100. That means I believe it's more important than ever to diversify away from crypto as well. What we've got over here is the gold price relative to the Bitcoin price. And of course, long term, Bitcoin tends to outperform gold, right? Gold tends to underperform Bitcoin. So Over time, we get more performance by taking on more risk. But it seems like there's somewhat of a trading range here, right? We tend to bottom out at similar levels and we tend to top out at similar levels. Now, this is by no means mathematically derived whatsoever. This is just randomly drawn lines. But it's interesting how those randomly drawn curved lines give us a relatively constant trading range. And we just look at that. It seems like gold is currently moving upwards and might outperform Bitcoin by still another 78% potentially. The risk of holding gold over Bitcoin is maybe 30%. So the risk versus the potential reward tells us that gold might be the better bet right now. At least partially, right? It might make sense to hold at least equal amounts of gold relative to Bitcoin. I'm not saying that you have to sell all of your Bitcoin, especially if your portfolio isn't really large and you can take the volatility, that's fine. But if you've got years of income saved up and you don't expect a lot of income going forward and the wealth you currently hold is very important to you, it is important to also be somewhat diversified and to have something that's risk off and still comparatively cheap. And I believe gold is in that spot. Bitcoin, on the other hand, is above its average cost basis. It makes sense to buy Bitcoin when nobody wants to own it, when the current price is below the average cost basis or the realized price. I like to look at this regularly. Currently, the average cost basis is at 43K, so the average Bitcoin investor is still in profit. And that profit might get taken to potentially buy something else. Attention on crypto is clearly slowing down. This is the search queries for both crypto and Bitcoin over the last 5 years. And while a video on the Trump meme coin just 2 months ago brought 855 subscribers and 61,000 views, the recently pumping meme coins make pretty much 0 views, right? So there's 500 views here and only 1 additional subscriber. Nobody wants to know about meme coins anymore. Too many people got burned. And so if nobody wants to hear about meme coins, if nobody searches for meme coins, where should the price recovery come from? It's probably not going to come from the whales, right? They are rather risk off right now. Check this out. This is the Bitcoin dominance. How much of all of crypto is in Bitcoin? And the altcoin rallies tend to happen whenever the Bitcoin dominance is at around 70%. So when only 30% of the crypto landscape is in alts and in Ethereum. That's when we want to get risk on. We are not there yet, and we might stay in a Bitcoin friendly environment for the entire year. The Bitcoin dominance continues to creep up. People don't want to own anything but Bitcoin. In the end, nobody knows where prices are going, right? That's why we diversify. That's why we've got different asset classes. The only judgment call that we can make is whether or not we believe that a certain asset class is currently comparatively cheap or expensive. And the only thing we can hope for is that the very expensive asset over time will mean revert, while the very cheap asset over time will appreciate to its fair value. What I'm doing during times like this, when taking additional risk does not lead to additional return, I'm simply just betting on most assets doing worse than the benchmark. For example, over here, right? This is Balancer relative to Bitcoin. It continues to underperform. Now, why does this strategy work? It works for crypto, but it also works for many other markets. It's because returns are very much concentrated in a few winners. The winner takes most. When you're buying a phone, for example, you want to get the best for you, right? So either the technologically most advanced one or the one that's best in terms of price versus utility. There's something where a particular phone has to stand out. And so all the purchases for phones in this example always concentrate toward just a few individual products. The same is true for companies, right? The winners tend to attract most profit. If you're hiring, for example, for an engineer, then it's much easier to attract the best engineer for the lowest price if you are Google compared to when you're just a small startup that hasn't established itself. Success attracts more success. That's why most companies will never catch up with Google. That's why most altcoins will never catch up with Bitcoin. And so you can make the mistake that most people make. You can try during markets like this to still pick the winner. You can try to find IP or maker and make money that way. But obviously you will have the odds against you. And that's probably why there's so little interest in crypto now. People intuitively understand this. There is some correlation within a market. Yes, Maker went up in the last month, but it's very hard to say where it's going from here, right? This is Maker in US dollars, but once we look at relative valuation, so this is Maker relative to Bitcoin, it seems like the trading ranges are a bit more tight, right? Again, because there's correlation within crypto. It makes sense to sell somewhere around these levels, and it very often made sense to also buy somewhere around those levels. So there's a tighter trading range in general relative to Bitcoin. And the 30% that we recently see is just a recovery from a massive crash we saw before. There are alternatives, right? For example, this is Balancer relative to Bitcoin. It's going down very consistently. The reason why it goes down that much is because the token supply increases. There's more and more tokens that go to the liquidity mining, and that then gets sold off over time, and that's then causing this very long-term underperformance versus Bitcoin. And this is how I make money. I'm simply just trying to get the odds in my favor. I believe actually it's easier to make money in a bear market than it is in a bull market, because still, even in a bull market, returns are very much concentrated in a few assets. And yes, those few assets might make a 5x or a 10x, but you have to be part of that rally. In a bear market, you don't have to find that many special tokens, right? Pretty much everything is going down. Some things more consistently than others. And so that's what I'm doing, and that's what I'm also sharing with the premium members of this channel. The link is down below, thebitcoinstrader.com. I share what kind of altcoins to short, why to short them, how to also mitigate risk, right? How we avoid getting stopped out, get liquidated, etc. Right? This is a whole nother learning curve as well. There's more than 100 tutorial videos in total in premium. Please don't get burnt out there. Please have at least a reasonable allocation to something that is risk off. If you got some value out of this video, feel free to subscribe, of course. Feel free to also join premium. Link is down below. A like would be very much appreciated as well. See you next time. Cheers.